about the interconnection between the same. Once we finish this, we'll move on to the chapter called working capital. So let's begin. Why dividend is so important? The dividend is so important because it gives an idea how the company is progress. If dividend is paid on a higher level, it creates a wealth and trust of investors in company. Dividend is indication that I'm able to generate the revenue, I'm able to generate the earnings, and I'm able to make my profits for my investors. So indirectly, dividend is a responsible factor for trust and share price of my company. So if I have good amount of dividends, then my investors are very satisfied and they will be happy about my growth performance and they will be having a trust or a faith in my company. And this will help me for long term association and valid financial development. If my developments are steady and they are moving in simultaneous to the organization, then making critical decisions and following different strategies for wider development is very easy and effectively possible. So, if I study the dividend policies, I come to know about the company's growth, I come to know about overall development, and I come to know how these strategies are playing important role in my decision making. Most important, if I study dividend policy, I will come to know what are the different strategies, methods, and modes the company is using for controlling its financial health, how they are valuing investors, how they are valuing assets, how they are generating returns, and what is the potential a company has. This all I get if I study the dividend policy of a company. Now, traditional dividend model, it talks about expectation of future dividend. When we see the Gordon's growth model, it talks about dividend growth and its earning on investment returns. So, Gordon's model is basically talking about how the things we are progressively going and the things are happening in a positive framework regarding same. So, the first model which we have is dividend discount model. It is called DDM. The model represent on discounted values. So as per this model, the future income which we are generating has less value in current price because the value of money which I have 1 rupee now will be declining in future. So as per him, the future investments are need to be assumed in discounted rate. This model assumes primary cash flow for shareholders is their equity investment. And as per Gordon's model, they are saying that if I receive after 1 or 2 years, the constraint is the flow of money and the value associated with. Now, who was Gordon and what is introduction? This model that is Gordon's model, was developed by Mayer Gordon in 1960 as a model for equity valuation and methodology. So he was economist and he developed this model in 1960. His core assumption was the values of stocks under the dividend will get grow at a constant if the rate of future is known. So as per him, the price of share will be increasing if the expectations about future growth is met. So as per him, if I'm continuously paying the dividends, I'm continuously showing the growth, profitability, then in that case, I'm able to create a trust in the minds of investors, and that trust will generate the confidence and continuous growth in future. So he emphasizes on growth factor, he emphasizes on loyalty, and he advocates that if growth and loyalty is associated with the company, it will give me more and more wealth and strategically the potential growth in future. So he give the formula that the price of share is equal to dividend divided by rate of return minus growth rate. So a simple formula he has given, but please remember when it is said rate of dividend, it is R divided by 100 because rate of dividend is always calculated in percentage. Whereas growth rate can be a percentage, can be a fraction. So I'll wait 2 minutes. Please read the formula. So if I compare, it is comparatively a easy formula where only the relationship between dividend and growth and rate of interest is calculated. So he is giving importance regarding the share price. Now, how the Gordon's growth model works? This model assumes dividend will continue growing at a rate and it is infinite of increasing payment. So as per his assumptions, once I start paying dividend, it will be going to continue. I'm going to pay the dividends in continuous way. There is no limit, there is no constraint about payment of dividends, and company is going to make progress. He calculate the value of future dividends in discounted, so he gives attention toward the concept of present value. He challenges the formulas used by various people for calculation of dividend, and he only focus the concept on growth and the interest rate available. For him, the dividend, if I compare to the growth and interest rate available, then I can easily talk about what is the price of my shares and how the confidence or trust in my company or organization is growing. So he is assuming continuous growth rate, present value of money, and he ignores that any other factors are making impact over the dividend. Now let's talk about key assumptions of this model. The first assumption was there is regular payment of dividend. The company or the organization is going to pay the dividends on regular basis. There will be no break, no stop for any reasons because dividend is a continuous activity and it is always being paid by the company. Second, it assumes that return and growth rate they are continuous. The rate of dividend is always changing and it is a progressive. What do you mean by progressive? It is increasing. In case of growth rate, it is always more than the last and it has no limitation. I'm always doing a growth, I'm always progressing. And he assumes all other factors as a constant. So, as per him, the financial and operating leverage they do not leave their characteristics, they remain the same. There is no change in other values and business model of a company. Everything remains same. Only the dividend and growth rate is changing. And this growth rate, he assumes, is change in turnover. So growth rate means how much my turnover, how much my sale is changing with compared to the last year. Whereas the rate of dividend means how much dividend is paid to the investors. So as per him, these two things are always changing, and all other things, that is company's turnover, profitability, or sorry, company's financial leverage, operating leverage, mixture of capital, or holding of assets, this will remain constant. There is no change. Only change in dividend, change in growth. And also he assumes government will not play any role in this policy because if the dividends are paid high, it might be taxed, but he assumes there is no taxation in this case. Why he make this assumption? The first thing he want mathematical integrity because his formula is more mathematical expression than the reality. Second, he want to limit himself to the companies who are giving stable dividend and having a good mature business models. He want to ignore that companies which are not able to generate profits and not declaring any dividends. So his interest is for generating continuous dividend and giving highest growth rates. Now let's talk about application. Now before application, let me talk what is the difference between dividend and other values. When I talk about dividend, it is always income side. And when I talk about growth, it is always on value maximization. So when I say dividend, I am always calculating the rate of return rather than growth. So this all theories of dividend focus on the concept of returns to the shareholders, and that's why they always talks about price of share. Because if I get a good returns, I will invest in this company, and if I don't have great returns, I will not invest in this type of company. Now let's talk an example. My next year dividend is 2.04. I want return at least 10.13%. It is found my growth rate is 5%. Then what is my formula? It is dividend divided by R minus G. So if I calculate, so 2.04, that is the value of dividend. It is 2.04 divided by Now, what is the rate of interest? It is 10.13. So when 10.13 is divided by 100, it means 10.13 is divided by 100 because it's a percentage. So this 20 will pass this point towards here and it will become 0.1013. So it is 0.1013 minus, now what is growth rate? It is 5%. Again, when I calculate the 5%, it is 5 divided by 100. So again, this 20 will pass. So 0.05 because two zeros I'm calculating. So I will minus it. The answer what I get is rupees 39.77. So this will be price of my share. Please go through the slide. If any doubt, ask me. We can repeat. Or if you want, you can just post in chat box. I will explain again. So let me go back to the formula. It is dividend divided by rate of return minus growth rate. So I'm sharing a whiteboard for I'll share the Excel sheet more better. So I can show the calculation of 2, 3. So the formula which I'm going to use is price of share is equal to dividend divided by rate of return minus growth rate. So suppose the I'll find two numericals, dividend. So we'll take the first basic that the next 1 year I'm getting dividend of 500 rupees. My growth rate is assumed to be 10% and my rate of return assumed to be 5%. So if I want the price of share, then it is equal to 500 divided by rate of return minus growth rate, and the price will be 1000. Why? This is negative because growth rate is more. If I change the value for this simple, then the price of my share will be 1000. Now suppose I take it for 2 years, and second year the dividend was 700, growth rate was 7%, and rate of return is 11%. Now, when I go more than 1 year, I apply time value. Suppose here PV factor is 0.8090. Then I will first find out what is the value of dividend. So it is equal to 700 into present value factor. I'll get the value 566. And now when I'm doing calculation, instead of using 700, what I will do is 566 divided by rate of return minus growth rate, and I will get what should be price of share. So the price of share should be 14,157.5. Now, if I change the value of dividend as 300, the price will change. If the growth rate is 9%, the value will change. So only he considered dividend, rate of return, and growth rate. Now, since in this Excel, I put the values as percentage, I'm not required to add zero. Okay. So let's go back to our PPT. So this is very simple way what Gordon has proposed, how to calculate the price of share. This model is using discounted cash flow, and it gives importance towards time value of money. In this model, we can have multi-stage generating value. For example, for year one, I can generate one value. For year two, I can have different value. So multi-value generation is allowed. It is only simple calculation that A divided by B minus C. So it is not so complex to understand, and it is always giving a direct idea what is the price of my shares. Now, this price I need to compare about market price and cost price. And based on that, I need to take a call. Shall I invest this company or not? If I find the Gordon model, the answer is 10. That is, price of share is 10, but in market, the price of share is 20. Then I should hold my investment because even the growth is shown, the growth with capital return is a tremendous difference I can identify. So in this type of firms, I will not invest. In reverse side, if the market price of share is only 15 and Gordon model shows the price of share as 20, Then, based on P ratio and technical analysis, I can take a call how much to invest and when to invest. So basically, when I invest in company and I need to take call about pricing, the Gordon's model is the basic foundation for understanding shall I invest? If yes, how much and when? Let's talk about strength and limitation of this model. This model is sorry, very simple and easy to understand. I don't require a complex data, only growth rate, dividend, and desired rate of return. Three values will solve and I'll get the price of share. This model focus basically on stability and growth of organization. This emphasizes that organizations continuously pay their dividend and their profit should be growing continuously. So this model supports growth as well as this model has strength of multi-stage calculation and this also undertakes the time value of money. So overall, easy to understand, easy to operate, and easy to recognize with less data is a strength of this model. Now, what are the limitations? It is assumed the basic assumption that companies are growing. So if we assume the company is growing, it's not feasible that in all cases or always a company is making progress. So the basic assumption that the companies are making constant growth is not working. Secondly, this model is only a mathematical relation between the rate of return and growth, whereas the other factors, that is retention, capital mix, is ignored. Then one more limitation is their assumption that financial and capital leverage remains same. Over the period, the financial and capital leverage will going to change. The decision-making authority, the future plans, the expansion purpose, the taxation. So all these factors are being ignored by considering them as constant. But actually, these factors never remain constant. So the good assumption of this model is growth rate, and the most cautious limit or most greatest limitation of this model is growth rate because growth rate is we cannot expect a continuity. It can be fluctuating or it can be continuously good. And this is assumption and limitation of this model. Let's talk about strategic insights and extension, which this model enables. As we have discussed earlier, this model gives me value proposition whether I should invest in shares or not. If the price given by this model is lower than the market price, then I can postpone or cut down the number of shares investment. But reverse way, the price of this model is high and market price of that share or investment is low. It means the stock or the company has a potential, but in market the company is undervalued. So I should go and purchase that shares because in future they will generate more great returns for me. This model gives a clear idea that whether I'm progressive, I'm able to match my growth rate or not. So I can calculate values for multiple years separately, and this will help for my strategic policy regarding how much dividend to pay, when to pay, and also give me focus that how a steady growth need to maintain by the company. So I will wait for 2 minutes. Please read the conclusion. So this model is a foundation tool which creates an impact over understanding what is the price of stocks based on dividend decay. This is the best and clear framework of dividend divided by rate of return minus growth. It is useful for across the domains because of its simplicity and clear indication. This helps for policy making decisions and for strategic framework to clear the formats of progressive growth. So this was the first model of dividend policy. Any doubts in this model? So I guess there's no doubt. So let's move further. The second model is called as Walter model. James E. Walter has developed this model to understand corporate finance and shareholders value creation. So let's see. James E. Walter has created this model during 1950 to 60 as a finance theory. As per him, more importance should be given for wealth creation rather than pricing of shares. So he gave importance for internal rate of return and wealth maximization of shareholders. He want to have dividend or policy of dividend in such a way that they will enhance the better relationship between retained earnings, internal rate of return, and firm's value. He directly opposed the previous policies which lacked and only focused on growth rate. He want a dividend policy to focus on firm's value creation. So if I'm able to do the wealth maximization or value creation, I'm doing a better task. So as per his idea, the dividend policy will be the most effective or most adaptable when it is creating the value or capital or growth appreciation for investors. So what is the core concept of Walter? As per him, the rate of return is more motivated if internal valuation or internal financing is more. If I focus on external debts, it will not give me any dynamic value and it will always be outsourcing my profits rather than any more retention in the company. He advocates that the cost of capital should be the minimum and growth rate should be higher. So if maximum funds are retained in company, that will generate more and more growth rate. So as per him, the company need to focus on lowest capital value and higher rate of retention. It means whatever the profit I'm having, the maximum profit are kept in company and less is issued to the equity holders. Like Gordon, the Walter also has certain rule. As per him, when retained earnings are more and we are reinvesting, then I don't require to pay the dividend. So he says if I have profit of 30,000 and instead of paying 30,000, maximum part if I retain in company by other means, that is bonus shares, right shares, or other documentation, or by increasing value of shares, then it will maximize my reinvestment opportunities. Whereas if dividend policy is irrelevant when rate of return and growth rate is equal. In this case, when they are equal, we will find the dividend policy loss its importance because it is not making any impact or decision about value of firm. Whereas maximum dividend if paid to avoid poor resource decision, then the cash to shareholder will be has external opportunities to welcome. So if I have funds and I pay out maximum dividend, then for future investment or expenditures, I need to borrow, and that will increase my debt cost. So he proposed that there should be delicate balance between investment returns and cost of capital. If I just talk about share price and ignore the cost of capital, the financial efficiency, the operating efficiency, then the long-term value proposition of my firm will start declining. So he mainly focused that there should be balanced approach rather than only focusing on growth rate. So let's understand what is the formula. So it is dividend and K is cost of capital. Dividend divided by cost of capital into rate of return into earnings minus dividend divided by cost of capital and whole this is divided by cost of capital. So he has given two components. One, present value, and second, reinvestment. So present value he has calculated when we divide dividend divided by cost of capital, and we calculate present value by formula, that is second part, R into E minus D divided by K and whole divided by K, where R will be rate of return and K will be cost of capital. Please read the formula and I'll give time to read the slide, then we'll continue further discussion. So let's continue. What are the assumptions of Walter model? As per Walter's model, the first assumption is the firm is having no external borrowings or equity financing. Whatever the money required, it is created by internal retained funds. So what are the profits? They are retained in company and they are only used for managing their future capital needs. The firm is having constant returns and capital, but the cost of capital over the period remains same. Why the cost of capital remains same? Because I'm not borrowing from outside. I'm just generating internal source, and that will help me to maintain my cost of capital because the mixture of my capital is not changed. Earning per share and dividend per share remains constant because number of people holding my shares is same. My growth rate is continuous and my cost of capital is same. So my earning per share, that is EPS and dividend payout ratio, will remain same. The most important, he assumes that whatever the profits available, they are either paid or retained fully in company. No other use of the profits is allowed as per his theory. So either I should reinvest or retain or I should pay to my equity holders the available profits. If I'm not doing this, then the theory will not work. Similarly, he assumed the company operates indefinitely and there is no issue about its existence and financial performance in future. So please read the assumptions. I'll wait for 2 minutes. So let's move further. This assumption is a theoretical creation that instead of depending on outside sourcing of funds, what if the profits are created, please retain that and use that for your own purpose. This model, however, has limitation of same because in modern finance, using only written values will not create a finance. I need to also borrow from outside. Growth is expected and desired to be constant, but in practicality, it is not always achievable. And this is again a greater limitation, or this is a constraint to make this theory work properly. So he assumes the higher return reinvestment strategy. When the internal returns exceed cost of capital, firms should retain all earnings to fund profitable expansion projects. So he advocated that if internal rate of returns are more than cost of capital, then I should invest everything back in company and there should be no dividend. For example, if my profits are 20% and cost of capital is 10%, then why should I borrow from outside? If I have profit available, retain it instead of giving, and that will help for not payment of cost of capital. In case of startups and high growth companies, reinvestment of profit is always welcome. But seasonal companies or companies with non-technical output, for them, this strategy will not work. In initial period, even though cost of capital is high and returns are there, they has to pay the investors. Because if I stop paying the investors dividend, they will lack the confidence and the investment in venture capital will be limited. So I should focus on high return investment strategy, but also take in cognizance the cost of capital and value of firm. Then the second equation he has given that I should maximize dividend distribution. The available profit should be distributed to all its shareholders. If I have zero dividend, I'm doing maximum growth. But in case I'm paying everything, then this will maximize my dividend distribution. But companies will face issue because if everything is paid, then for my future growth, I don't have any money. So if I'm paying high dividend, it is assumed that company has achieved maturity and no further progress or no further great expansion or change in company is desired. When I'm not paying any dividend, it is assumed the company is having higher growth rate and it's just a beginning. But when I pay maximum, it is assumed that I reach to my bottleneck and now I need to think about how to progress further. So please read this slide. I'll wait for 2 minutes. Let's move further. So the rate of return and cost of capital, he has three propositions. When internal rate of return is equal to cost of capital, dividend policy will not make any impact on share price. So if I have internal rate of return, that is the return value, is equal to cost of capital, then there is no difference in share price. In case shareholders are satisfied with retention of earning, then these companies are more making growth and showing steady progress. So this will not also make any difference to the investors because they are getting wealth creation. So they are benefited, they are being paid dividend, but not directly. It is retained in organization with some strategy. When I have a higher payout ratio and dividend retention, the firm gets a freedom to take a call about its future plans because it has retained earning. It's one of the internal source of financing. And this gives management the maximum flexibility to take the decision, to take the risk, and generate more and more returns. Now, what is the criticism or limitations of this theory? The first limitation is its basic assumption that I should retain maximum. If I retain maximum, then sometimes the investors will not happy. So I need to understand market. Similarly, if the debt finance is available on cheaper rates or convenience, or I can go for mergers and takeovers, then in such case, dynamics of financial market conditions, I am unable to understand. And if I have huge profits and outside borrowing is cheaper, then I can invest my profits and take the differential benefit. So this dynamic is ignored by this theory. In many cases, this model overlooks the imperfections and ignored the other values associated like taxation, preferences, market competition, law of information, and various fees and charges applicable while collection of cost of capital and also in case payment of dividend. So we can conclude Gordon advocates that value of shares is depend on difference of growth rate and rate of return, whereas Walter says if everything is held constant, what amount of dividend I declare and retain, it makes impact on shareholders' price and their wealth maximization. So when I declare dividend, I should focus that the maximum growth is achieved. I should not depend on external finance. Rather than I should focus on my internal retention money, which is easily available and statistically giving higher growth rates. So these are the two models, that is Gordon and Walter. Let's talk about MM approach. So Gordon has proposed growth, whereas Walter has proposed wealth creation. So there is always a doubt how the things are going to work and making an impact. Let's talk about what is MM model and his irrelevancy theory. This MM model is developed by two people, Franco Mudlin and Merton Miller, in 1961. For this model, they were Nobel laureates. They do a revolutionary claim that dividend policy do not affect value of price and its overall market value. So till date, there are two economists who advocate the dividend policy, as per Gordon, make impact over the price of share. As per Walter, dividend policy is related to the value of firm. But now Franco Mudlin and Martin Miller, they says the dividend policy does not affect neither on stock price nor on share value. They assume that the perfect market will make no issue about dividend and capital gains, and there is no consideration. Please read these limitations. I'll wait for 2 minutes. Please read the share slide. I'll wait for 2 minutes. So these are the assumptions of Walter model. First assumption, no tax. There is a perfect flow of information for all investors, and investment decisions are not affected by the policies. They also assume that there is no cost for new shares issue. So, as per MM approach, dividend policy has no relation regarding investments. You declare dividend or you don't declare dividend. It will not make impact on wealth creation as well as on value of shares. They both will remain neutral. So dividends and cash flow they are compared. Investors will sell the shares if there is a low dividend to generate the cash flow, and investors will buy the shares if there is a higher dividend. So it is not a role of dividend because getting dividend is not only the aim of investor. He has multiple decisions like prestige, status, wealth maximization, securing future returns, and hence, as per them, only the cash flow is impacted for individual investors or corporate investors after dividends are declared. If higher dividends, they will more buy the company shares. If lower dividends, they will sell the shares and further go for dividend paying company. So, they are given example. If annual earning is 100 million, then his total earning is available for dividend declaration. If suppose I retain 50% and 50% I pay dividend, then the value of firm will be more increasing and it will become 1050 rather than only making happy to the investors or company. So they says don't retain everything or don't distribute everything. Find an appropriate percentage that how much you can retain and how much you can give. The optimum value which generate higher value for your firm, that will be your beneficial. So as per them, how much to pay and how much to retain, you should calculate based on what will make impact on the value of firm. Now what happens if dividends change? Paying 100 million or paying 100 rupees as a dividend will require issuing 50 new shares. So if I adjust the dividend by retention, I adjust the dividend by payout ratios. The fall of price will be there because dividend not declared. But since I'm paying in kind, that is the bonus shares for right shares, again the dividends are rising proportionately. Therefore, I pay or I retain indirectly. I'm creating value for my shareholders. I'm giving benefit to my investors. So there is no relation between payment of dividend and the investor's confidence or wealth creation. Now, what are limitations of this model? The MM approach has limitation that they do not consider dividend policy as finance decision. For them, apart from dividend, there are multiple factors which make impact on pricing. Similarly, dividend is not only sole purpose of investment. Firm size, future investment, profitability, these all focus factors of investment are ignored. Here, investors don't care about returns is a bold assumption which is practically not possible because investors are more bold and they are worried about the returns and maturity. So total return values are more here the consideration and the same is limitation of theory. So if I compare the three theories of your syllabus, Walter says the first theory that the value of firm will increase when I am paying more returns. Then the price of share will increase. So Walter advocates on more dividend payment and increasing price of share. Whereas Gordon says, sorry, Walter says the wealth maximization should be there and I should retain maximum. Whereas Gordon says I should pay more and increase my dividend payout ratio. Whereas approach says don't pay much or don't return maximum. You should have balance between paying dividend and retaining dividend. The balance should be optimum and it should create interest in firm. If for Gordon, if I pay more or for Walter, I retain more, it will create imbalance. So I need to find the perfect combination of Gordon and Walter, which maximize my value and goodwill in the market. So again, the transaction cost, information flow, these were the two limitations of MMI approach because flow of information is not always accessible. Financial information is always confidential and flow is not possible. Similarly, transaction cost and tax, they are going to change, which is assumed to be constant. There are also some religious and social impactful factors which makes impact on financial decisions and which is also ignored by MM theory. So why still companies pay dividend? Because it will give a financial boost and indication that company is progressing. And investors always give preference when the companies are paying dividend. So we have three types of dividend policies in exist. One is a stable, second constant, and residual. The stable dividend policy means a fixed percentage of dividend is given. Constant dividend policy means I'm paying dividend, but not a fixed rate. Depend on profits, the rate is fluctuates. And the residual dividend policy means I only pay the dividend if anything is available out of profits after paying interest, tax, and depreciation. So either I will pay it fixed rate, I'll pay it on reduction rate, or I will pay as and when it is available. So these all three theories are not near to reality because they assume taxation and the investors' preferences remain same. Only they consider dividend. Like Gordon advocates, the rate of companies' shares should be impacting by dividend. So I should pay more, then my price of shares will increase. Walter says I will get more investments if the more return because this will avoid external borrowing and in long term this kind of dividend policy is welcome. Whereas approach says don't return maximum or don't pay maximum. You have to find the balance between holding and payment in such a way that it will create trust and future flow. If you are getting external finance more easy, then focus on that finance. So these are the three theories of dividend. Now we finish our fifth unit, that is dividend theories and dividend models. Now we'll focus on last chapter of AFF, that is working capital, and then we'll finish the syllabus of advanced financial management. So please read the syllabus. If any doubt, ask me. So we'll join at 8 o'clock for direct taxation last session.